Today we're going to talk about a very exciting subject, and that subject is how to manage your money. And to do this, we're going to use accounting. But first off, we need to understand what is accounting. If we go back to the concept of the 7 resources of reality, we see that we have time, money, energy, space, matter, knowledge, and human relationships. And accounting is essentially the management of the resource money. So in the previous video, we looked at how we can manage our time using Notion. And in this video, we're going to see how we can manage our money using accounting. So accounting is the management of money. I learned about this when I started my bachelor's in business administration, and it was mind-blowing when I first learned it, because it allowed me to see how I manage my money and what I'm doing wrong, and also how much money I really actually have, not just the number that shows up on my bank account. Now, the most fundamental concept in accounting is the accounting equation, which says that assets equal equity plus liabilities. But to understand this, we first need to define what assets, equity, and liabilities mean. So let's define them first. So here is how I define assets, liabilities, and equity. So I define assets as money and resources that can be exchanged for money. Now, examples of this are physical money that you have or digital money that you have, for example, in your bank account. But it can also be clothes that you have, but you can sell to someone in exchange for money. So it can also be a car, a resource that you have that you can sell to someone in exchange for money. So essentially, all of those are examples of assets. Now, liabilities, I define them as money and resources that you owe someone. So an example of this is when you are at a bar or at a restaurant, and at the bar you order drinks and they are served to you, but you don't have to pay the bill yet, only after you finish. And likewise, in the restaurant, you order the meal and the food that you want to eat, they serve you and you eat it, but you don't have to pay them in the present while you are eating. But in the background, you are essentially creating a liability that you will have to pay them back when you finish. So after you finish drinking and you leave the bar, you have to pay the bill, and that's essentially the liability that you have to pay. And in the restaurant, you have to pay the bill of the food that you ate, which is also the liability that you created. Other examples of liabilities can be loans of money that you make with someone else. Examples can be students and banks. So when a person wants to study at university, but they don't have enough money to survive by themselves, that is to pay for food, rent, and other expenses, they can take up a loan from the bank, and the bank gives them the money to do those things. But after they are finished studying, they'll have to pay back the loan, the original money that was borrowed, and interest on top of that, which is extra money. So the bank earns money by doing the loan. And equity, it's money and resources that are left after you subtract liabilities from assets. So we will see what equity means in a moment. So let's look at an example. So we have Stacy, which just graduated from college with a bachelor's degree in politics. Now, Stacy has Stacy has $300 in her bank account. She has $10,000 in her savings account. She has a car that she can sell for $3,000. And she has a student loan debt of $35,000. So if we were to categorize these as assets or liabilities, these ones here would be assets, while this one here would be a liability. And now let's calculate the equity that Stacy has. So if we calculate the assets first, and we have here the savings account, the car, and the bank account, and we sum this up, we get $13,300. So those are the total assets that Stacy has. And in liabilities, Stacy has $35,000, only the student loan. So now to calculate the equity, which is the money and resources left after subtracting liabilities from assets, we just take the accounting equation, which is this one, and we subtract liabilities from both sides, so we have equity alone. So after we subtract liabilities from both sides, it looks like this. And now when we have liabilities minus liabilities, it's just the same as you have something and you subtract the exact same thing. So if you have 100 and you subtract 100, you're left with 0. So essentially nothing. So we can essentially just remove these two liabilities. And we are left with assets minus liabilities equals equity. Now what we can do so it looks nicer, since we're focusing on equity, is that we can essentially just flip these sides and switch them because they mean essentially the same thing. So now we have equity alone from the equation, which is what we'd want to find out from Stacy. And next what we can do is plug in these values for assets and liabilities that we have here, and we can essentially calculate the equity that Stacy has. So here we get 13,300 minus 35,000, and after using the calculator I get minus $21,700. So Stacy has an equity of minus $21,700. Now if Stacy was a business, that business could go bankrupt because it's insolvent, which means that it's a very high risk that the loan will never be paid back or the liabilities will never be paid back. So in financial terms it means that Stacy's financial health is not very good. So now let's look at another example. We have Jacob that has worked lots of years as an engineer and has gotten into the real estate business, and he has $5,000 in his bank account, $300,000 in an apartment he has bought, $50,000 on a car he owns, $200,000 that he owes on the mortgage that he used to pay the apartment, and he has credit used on a credit card of $7,000. So now let's calculate the assets and liabilities and then the equity. So now after calculating the assets he has, which is his bank account, apartment and car, we get $355,000. And calculating his liabilities, which is $200,000 on the mortgage and $7,000 on the credit card, he has a total liabilities of $207,000. So now we have the total assets and liabilities, and we can now calculate the equity. So now after calculating the equity on the calculator, I got $148,000. So the total equity that Jacob has is $148,000. So he has positive equity, which is a very good thing and means that Jacob is in good financial health. Now in the previous example we saw Stacy, which had bad financial health because the liabilities outweigh the assets. So when you get to this equation, since liabilities is greater, the greater sum here becomes negative as compared to if the assets are greater, as we see that they are in Jacob's example. Now it's quite normal for students to have negative equity, bad financial health, because they haven't started earning money yet or saving, so the student loan that they have outweighs the total assets that they have, which means their liabilities are greater than their assets. The next thing in accounting that we have to learn is accounts. So what is an account? So I define an account as a register for money or resources that can be exchanged for money. An example of these resources that can be exchanged for money, it can be a house, a car, essentially any asset that you can sell and receive money in exchange for. And accounts, they're essentially a tool that store the different transactions of the type of asset that you have. So here's an example of an account, and this is the most common account that we have, and it's a bank account. So a bank account is a register that is used to track and store the transactions of the money that you have in the bank. So here we see the transactions in the month that are registered for this current month in May. And we see that the bank account has received $1,000 from a student loan. It has lost $65 to the grocery store. It has lost $100 to the gas station. It has received $100 from the father of the person, and it has lost $600 to the landlord. So these are normal transactions that most people have. So here we see that is a student that has this bank account, and he or she receives $1,000. Then they spend some money to buy groceries, to buy food, then for the gas station so they can get fuel in their car so it works, and then they received some money from their parents, and then they use the money that they have to pay for the rent of the current month. And if we want to calculate the balance, the total amount of money that is left in the bank account, we subtract and add the money received, and we see that it has $135. So in accounting terms, we would call this one entry, a single entry bookkeeping. So in single entry bookkeeping, you only have an account that you add or subtract the resource or money per transaction. But a better way of tracking your money and managing it in accounting is actually the double entry bookkeeping system, which I'm going to show you now. So the double entry bookkeeping system, it essentially is the bookkeeping of accounts where each transaction involves two accounts that are increased and decreased. And to understand this better, we need to go back to the accounting equation where assets are equal to equity plus liabilities. So in practice, you would have one account for the assets, an account for equity, and an account for liabilities. And if you, for example, use money on one of them, you have to decrease another account, so the accounting equation is still true. So what we want is that the accounting equation remains true in order to track the transactions and where money goes. So if we, for example, have assets, we have a bank account that we use money to buy groceries, for example, for $100. To update our assets, we would have to subtract $100 from the assets, but then the total assets would be less than the equity plus liabilities. So the equation would stop being true. But in order to keep it from being true, we also subtract equity. So it balances, it stays balanced. And vice versa, if we, for example, take up a loan and receive more money, for example, $1,000, but we have to pay it back because it's a loan, while we increase $1,000 in the assets, we also have to increase $1,000 in the liabilities. And the two names that we use to define increases and decreases in the different types of accounts in a double entry book system is debit and credit. Now, debit and credit, they can either mean an increase or decrease on an account depending on the type of account that it is. So, debit and credit can be an increase or decrease depending on the type of account that they are applied to. And in order to understand this in practice, Here we have an example of a person called Mark. He has $1,000 in his bank account, $10,000 in his savings account, student loan debt, car, apartment, mortgage. And these assets that he has and liabilities, they are changed depending on his income and expenses. So these are also important concepts that we need to understand. And income is when you receive money, and expenses is when you lose money or decrease money. And income is usually money that you get from working or selling something. So if you work at a normal job where an employer pays you a fixed amount of money, depending on the amount of hours that you perform a task, or if you are a business and you sell a product to a customer, the money that you receive from your employer or the money that you receive from your customer, that's your income. But if you receive money from a loan, it does not count as income. An income is essentially an increase in your assets that is not a loan or a liability that you don't have to pay back in the future. So if you receive money or resources that you don't have to pay back in the future to the supplier, then that is categorized as income. So let's look at examples of this. So if we look at these transactions that Mark has gone through, essentially Mark receives $5,000 from his salary and Mark spends $300 on new shoes. Now, the moment he receives these $5,000 from salary, they usually go into his bank account, so this would increase by $5,000 and it would become $6,000, but since the assets increase, one of these also has to increase. And in this case, since he does not have to pay this back, the equity would increase. So now we could have the equity account here and increase it while we increase the assets as well. But the problem with that is that we would lose track of how much money he has earned and how much money he has spent, because you would essentially just sum up each of those. So in order to organize this better, we use income and expenses accounts before we adjust the equity in the accounting equation. So this transaction, Mark receives $5,000 from salary. It involves two accounts, and in this case we have his bank account and salary income account, a register that we use to store the transactions involving salary income. So we see that right here we have debit $1,000 in the bank account because it's the initial balance, and when we use debit on assets, it means an increase in assets. So if we debit an asset account, which a bank account is a part of, since bank account, savings, car, apartment are assets, when we debit those, we essentially increase the total sum. While if we decrease those assets, we credit the account. So since Mark receives $5,000 from his salary, we essentially debit $5,000. But now, since we only debited the assets account, we need to update the equity. But before we update the equity, we register the income so we can later compare how much income we have had each month. So since we have a debit already, the next one is a credit. So when we increase assets with the debit, you increase equity and liabilities with a credit. So each transaction involves debiting an account and crediting another account. So here we will get credit $5,000. So if we now go to the next transaction, which is where Mark spends $300 on new shoes, since he is spending money, an asset that he has, we have to credit the asset account. And since we credit an asset account, we also have to debit equity or liabilities account. In this case, it will be the expense account that we later combine the expense and income to calculate the result that we update the equity with. So it looks like this. Credit $300 on the bank account and debit $300 on the clothes shoes expense account. And the accounts that you create depend on how you want to track the expenses that you have. If you just want to track, for example, groceries, you can create a groceries account. So at the end of the month, you can see how much money you spent on groceries. Also for clothes and shoes, or eating out, or traveling, or going on vacation, you track and create new accounts, so you store the information. But at the end of the month, usually, you want to calculate the balance of each account. So an assets account is a debit account, which means that the total balance is in debit, while income account is a credit account, which means that the total balance is in credit, while the expense account is debit account as well. So at the end of each month, what you want to do is calculate the total debits and the total credits in each account, and then you subtract the credit from the debit, or credit from debit, or debit from credit, depending on the type of account that it is. So in the example of the bank account, we sum up the debits and subtract the credit. Calculating the balance for the bank account, we see that the balance is $1,200, and because it's a debit account, it's in debit. While these other accounts, we just keep them as they are, because we haven't lost any salary that we had to return, or we haven't returned any resources that we have bought in order to receive the money back. So these ones we just keep as they are. Now, if you obviously would have had more debits and credits here in the income, then you would obviously sum them together, and the sum would be the balance. So now that we have the balance for the bank account, salary, income, and expenses account, let's calculate the result for this month. So to calculate the result, which is income minus expenses, that we then use to update the equity account, we essentially sum all of the income accounts that we had this month, and we subtract the sum of all the expenses accounts that we had this month. So in our example, this is the income that we have had, and this is the expenses that we have had. So updating these ones, we get $5,000 minus $300, and we are left with a result of $4,700 that is positive. So if it's a positive result, we call it profit, while if it's a negative result, we call it a loss. So here, Mark has gotten a profit of $4,700. So now, after calculating the equity for Mark, equity account, you essentially just take all of the assets, bank account, savings, car, apartment, you sum them together, and then you subtract all the liabilities, which in this case is student loan debt and mortgage. And the result is $116,000. So after getting the result, in the calculation of the accounting books, you essentially debit the result account, $4,700, and you credit the equity account, $4,700. So to update each of the accounts, we would update the bank account with $1,000 200, like that, and we would add $4,700 to the equity account. So I just noticed that I made a mistake in my calculation, and I essentially, instead of $5,000, I treated this as $500 and just subtracted to get the 200 for this. But it's actually 5,000, and the correct result is $5,700. So here, now it's correctly $5,700. And if you notice, the equity increased by $4,700. So this one increased, but the bank account also increased by the result, which is the money left from after you take income minus expenses. So it also increased by $4,700. So you see that we were able to keep the accounting equation true. And on top of doing that and updating the assets, equity and liabilities that Mark has, we're also able to create this information about the income he has had and the closing expenses he has had, so that later on, as you get more and more transactions, the sum becomes interesting because you can then use that data to budget if you want to decrease your expenses or where you want to allocate your money. So that was the foundation of accounting and the basics that you need to be able to do accounting. Now, I know you might be asking yourself, why should I do all of this? It's a bunch of work, and you're right, it's a bunch of work if you do it manually and writing like this. But with software tools like Excel, it becomes much easier and you can automate it very fast, and the insights and the way you're able to manage your money will be very easy and efficient. So the video would be very long if I added the Excel tutorial after I went through all of this. So I'm going to provide you the Excel tutorial of how you can apply the accounting to manage your money in the next video. But for now, you have the basics of accounting, the accounting equation, and how you can understand the different ways that you can manage your money.